I typically think of three key areas that have their attention for the most part. First and foremost, I would say cyber risk. Insurers more and more are becoming focal points for hackers around the globe. Clearly, insurers over a number of years have developed and maintained significant sources of valuable data, and as a result, they're a natural target for cyber risk. Boards and management teams increasingly are focused on cyber risk and are spending more and more time, effort, and money ensuring that their organizations are ready to respond for when cyber attacks occur. Often what I hear is it's not a matter of if cyber attacks occur, it's just simply a matter of when. Secondly, I'd point to the regulatory and accounting change agenda. Insurance accounting globally is disparate today, and there was an effort several years ago, around converging that guidance across the globe. That doesn't look like that will happen, but between the accounting standards and the regulatory regimes, there are significant focus areas around the agenda as it drives finance and accounting and regulatory change, including capital. Finally, every insurance company is dealing with some level of transformational activity in an attempt to streamline operations, get closer to the customer, think of better and different ways to use technology and digital as a means of underwriting, streamlining claims paying ability. And we as auditors need to be responsive to those transformational activities. We also increasingly are coming under challenge by our clients to think about doing things more innovatively and to understand the impacts of those changes in business models will have on the audit process, and to do the audits in a more efficient and streamlined basis. I'd be remiss if I didn't talk about mandatory firm rotation and the new EU regulations around auditor change. The insurance industry, by virtue of coming under the definition of a public interest entity, lands squarely within the rules, whether they're based in the EU or whether they have subsidiaries like most global insurers do that operate in an EU or EEA country. Clearly, these regulations will be disruptive and force insurers to reevaluate what have been years-long relationships with their current accounting firm. In addition, the rules prohibit certain non-audit services as well, so companies will have to develop a strategy for developing relationships with other firms to provide services that today it seeks from its one audit firm. There's no question that the rules as drafted and the specifics around each of the countries in the EU and how those rules are applied will continue to emerge. Today, most describe those rules as being a bit of a patchwork of rules, and insurers will be forced to navigate that patchwork in coming up with a solution and a plan to meet the EU's mandatory firm rotation rules.